When is the right time to get funding for my business? You're not alone in wondering, should I raise capital now or wait it out? So let's break it down with what's really happening in the UK market. And if you wait till the end, I've got some free resources which I'll be sharing with you and some actionable tips that you can put in place in your company. Looking at the current landscape, the small to medium-sized business funding gap remains huge. Recent estimates still put it at around 90 billion in unmet lending needs. Now that means plenty of good businesses are still struggling to access capital. Despite some articles indicating otherwise, banks are also tightening. Now, recent coverage shows that major UK banks are reducing SME lending appetite in certain sectors, pushing more business towards specialist and alternative lenders. Now, investor sentiment is selective. Equity funding is still flowing, but investors are pickier and favouring businesses that show strong governance and clear growth plans and industries that are future-proofed. However, there is the SEIS. Now, this stands for the Seed Enterprise Investment Scheme. This is a UK government-backed tax relief designed to help very early-stage companies attract equity investment. Investors can claim up to 50% income tax relief plus capital gains exemption on future profits. Finally, rates are steady and have been reducing in recent times. So I guess it depends on the specifics of your business. In theory, early might be better if you're brand new with a great idea and potential clients but fear over trading. In the early days, it's very hard to raise pure unsecured debt without a couple of years' worth of profitable accounts. I guess that brings us on to debt versus equity. Debt is quicker to arrange and retains control and is useful for revenue-backed growth, but requires repayment discipline and can be restrictive on how much you can borrow. Selling equity dilutes shareholding and takes longer, but is better for scaling, although you can end up losing some of the control. I've actually done a whole article on venture capital versus debt versus bootstrapping, which you can read on my website. I'll put a link in the description. So looking ahead, what's changing going into next year? The Leeds Reforms will relax fundraising red tape from April 2026, raising prospectus thresholds and promising new channels. So if you're planning to raise in 2026, this could boost valuation or shorten timeframes. There's changes to companies' house ID validation, which could potentially make it more secure to transact in the B2B space. And while we may also see banks making quicker decisions when carrying out their Know Your Customer checks, I also think the current deadline for the Government Growth Guarantee Scheme, also known as GGS, which is due to expire in March 31st, 26, may see a further extension or even a replacement scheme put in place as before. But for any updates on these, you can subscribe to my page or even sign up to my newsletter via my website to be kept up to date with any important changes. So we've covered quite a bit there. From what's happening in the market right now to the pros and cons of debt versus equity, and even what's coming down the line in the next couple of years. To keep it simple, let's just summarize the key takeaways and put some clear action points in place. In short, the UK funding gap is still huge. Banks are cautious and investors are choosy. Rates are steady and there are useful schemes like the SEIS for early stage equity, while the Growth Guarantee Scheme remains an option for some. Debt tends to work best for revenue-backed growth, while equity suits bigger scaling ambitions. And looking ahead, reforms in 2026 may make raising capital easier. The key is matching the right type of funding to where your business is today and where you want to go. And to finish with the question at the start, when is the right time to raise capital? The truth is, it depends. I suppose if your business is already generating revenue and you've got growth opportunities you can't seize without funding, earlier is often better. You protect cash flow and you don't risk missing the moment. But if you're still loss-making or unsure on your projections, it can pay to wait until you've got clearer traction, as lenders and investors are far more selective right now. In other words, raise when capital will clearly accelerate growth, not just plug short-term gaps. I would recommend in any scenario that you carry out a funding readiness audit. You can also map your ideal vision and timeline and prepare early ahead of raising debt or selling equity. Essentially, each business is unique with its own circumstances. However, if you have a profitable business with a lot of ideas but struggling to cash flow your next project to fund that next stage of growth and would like to discuss funding options that are available to you, you can reach out to James Murray Finance or use our free resources and toolkits online at jamesmurrayfinance.co.uk.